All right, I guess we can start. So I have the first question from Parth, and he's asking me, can you explain the clearing mechanism? Well, this is not a question related to the derivative topic, because clearing mechanism is got more to do with how exchanges are settled. But I will still try to give you a little bit of a brief overview. Clearing mechanism is essentially nothing but the manner in which all the trades at a central exchange are settled. So, for example, there are members of the exchange, like the members of the National Stock Exchange and the Bombay Stock Exchange, who trade, but they do multiple trades in a day. And sometimes those multiple trades cancel each other out. The clearing mechanism, what it does essentially is it looks at the net position of each member and settles the positions of one member against the other, whatever is outstanding at the end of the day. That is essentially the clearing mechanism. The details of how it works is not related to this particular topic of derivatives. Yes, please ask your questions in the chat box. I'm still waiting for more questions. Your questions need not be only limited to the videos that you have seen. Any question regarding derivatives as a whole, please feel free to ask them. I'm sure derivatives is a bit of a complicated, for the beginners it's a little complicated issue, so I'm sure there must be lots of questions. Yes, thank you, Pawan. Good afternoon to you too. Well, actually, where I am located, it's morning, so good afternoon. Okay, so I have a good question. So I have a question from Park, and he's asking me what is the role of Vega and Rho. It's a very important question. So the thing about the price of a derivative, rather the thing about the price of an option is that for a vast amount of time, people in academic finance did not know how to price options because options were simply traded in the market, but nobody had really an idea of what was that price of an option or how that price of the option was going to be determined. And then two mathematicians or economists, rather three mathematicians and economists came together and they devised a formula to price options. And that formula came to be known as the Black-Scholes model for pricing options. Now the Black-Scholes model for pricing options basically makes certain assumptions and tries to figure out a price of an option. For what they do is that they say that the option is the price of the option is a function of, let me write this down so it's going to be a little clearer for you. So price of the stock, of the share of the stock or the underlying, sorry. Strike price, time to expiry, interest rates, volatility, and dividends. So they say that the price of an option, whether it be a call option or whether it be a put option, is a function of these 6 parameters. The price of the share, the strike price, the time to expiry, the interest rates, volatility, and dividends. Now based on this, they back out a price of the option. What Vega and Rho tries to do essentially is they try to look at the sensitivity of the price of the option to the volatility, this one, and to interest rates. So what essentially they're trying to say is that what happens given all parameters, let's say the price of a share remains constant, the time to expiry, like it's right now, it's happening, the dividends, okay, let's say that there are no dividends, So what will happen if suddenly the volatility of the underlying stock goes up? What will happen to the price of the option? And what will happen if suddenly everything else remaining constant, the interest rate of the interest rates prevalent in the country go up? What will be the effect of this on the price of the option? That is essentially what the Vega and the Rho are trying to calculate. Vega is the sensitivity of the price of the option to changes in volatility, and Rho is the sensitivity of the price of the option to changes to interest rates. Now, in the Indian context, Rho isn't such an important parameter when you're trading options. And the reason is that when you're trading in share market, when you're trading on options and shares, the maximum length of expiry that you have is 3 months. So if you look at this, if you go to, say, any particular share, let's say any particular option, let's say I go to, just give me a moment. So let's say I take up this particular option. No. So if you take, say, if you take the stock options of, say, Axis Bank, then the maximum number of expiry that you have are these 3 months. That's the maximum length of expiry that you have. And that's the farthest, longest maturity of option that you can trade on an Axis Bank is the one that expires on the 26th of November. Now, such small durations of time are not enough for interest rates to really make a difference. And that's why in the Indian context, Rho, when you're trading options, Rho isn't really a major Greek variable to look at. However, Vega is an extremely important variable to look at because Vega is essentially giving you an estimate of what is the implied volatility of the underlying stock. So for example, if this is the Nifty option shape, you can see that this IV, which is the implied volatility, it is in the range of something in the range of 20% to 22%. Now, I know for a fact that this is a high implied volatility, especially given the Nifty options. Because Nifty options, generally the volatility ranges in the range of 15% to 16%. Something in the range of 22% is a high implied volatility. And the reason is because the last week has been a terrible week for the Indian stock market. It fell the most in the 4 years. So because the last week was extremely volatile, that's why the volatility reflected in the stock prices is going on. So that is essentially Vega and Rho. Sachin is asking me to explain Theta and Delta as well. Delta is the most basic Greek. It's the most basic element of an option. It's essentially trying to measure the sensitivity of the option price to the movement in the share price. So for example, if I open this particular option, which is the 7,700 7,750 strike price call option with an expiry on the 24th of September. I see that it is trading at 135. Now, and Nifty currently is at 7655. That was the last closing of Nifty. Now, the thing is that what would happen, say on Monday, the Nifty opens and it is at let's say 7700. So the Nifty has gone up. So obviously, this price of 135 will also go up a little bit because this is a call option. Is it okay? Can you guys hear me? Yeah. Okay. So what would happen if this price of the underlying asset goes up? If the price of the underlying asset goes up, then the price of this call option will obviously go up. What Delta essentially will try to do is it will try to measure by how much will this call option go up if the Nifty goes up by 1 point. So Delta is essentially the rate at which the price of the option will increase or decrease given 1 unit of change in the underlying asset. So that is essentially what the Delta is measuring. Theta, as Sachin has asked, Theta is another very important Greek. Essentially what it does is that it tries to measure how much will an option decay over time. What does that mean? It means that this 135 that you see, let's say today is the 5th of September, on Monday, which is the 7th of September, the stock market's open. Until the 24th of September, nothing really happens. Quite unlikely because the stock markets are going through a tough time right now. But let's say hypothetically, till the expiry date, which is the 24th of September, nothing happens and the Nifty remains where it is. Okay, nothing much changes. The Nifty remains at around 6,600, 650. It doesn't change. What will happen to this option price? This option price will slowly move towards zero. Why is that? Because the strike price is 7,750 and Nifty at expiry if it's 7,650, then it is below the strike price and hence the option has no value. At expiry if it's at 7,650, then the option has zero value. But right now the options are trading at 135, which is a lot of money. So if nothing changes from Monday till the 24th of September, this entire 135 will completely vanish. Why is that? Because this 135 will decay because option prices have an inbuilt time value in them. And the more the option moves towards the expiry, the more we move towards the expiry, the price of the options decrease because of time decay. What Theta essentially tries to do is it tries to measure by how much will the option price decay with the advent of time. So let's say we move from one day to the other, we move forward by 1 day. How much will the option price decay if everything else remains constant? That is what the Theta is trying to measure. Theta is an important Greek because it gives you an assessment of what is your exposure to time. Unlike other parameters that I have shown here, for example, the price of the share, the interest rates, the volatility, we do not know what is going to happen about them in the future. But we know very well what is going to happen about time, and the time is going to move forward. There is no uncertainty about that. And because time is going to move forward, we know for a fact, for a certainty, that the price of the options will decay. Theta gives you a measure, an estimate of how much you would lose every day if you bought an option, be it a call or a put. How much would you lose because of time decay? That is what the Theta is trying to measure. I hope that answered the question on Vega, Rho, Theta, and Delta. So Nitin is asking me, how do we calculate the decay amount over time? So if you go to the e-learning market, the thing that you have, and if you download these strategies that I have made, let's say I download this bearish strategy. explain this particular Excel file, which is an important Excel file, and this will also answer the question by Sachin and the previous gentleman, Parth. Okay. Okay, so if you see this, and if you go to this theta part here, or if you simply go to this contract definition part here, where I give the underlying price, the date of today, and the expiry date. Let's make it 34th of September. So it's going to be 20 days or 90 days. Yeah. So let's say we make it 24th of September. Let's keep the risk-free rate at 10%. I keep it at, although the Indian Indian risk-free rate, as you would call it, is not 10%. It's somewhere in the range of 7%. But I will keep it at 10% because the NSE website, when they do their calculations, you notice here they also use 10% as an interest rate. Although that's not exactly correct, but I will just do that to be inconsistent with how the NSE is doing their calculations. But keep in mind the interest rates today are not 10%; they are near in the range of 7%. So a dividend yield I will set at 0. And you see that if I have, let's take the option, this Nifty call option. So let me build the contract. So the Nifty is at 7655. So I will write underlying price at 7655. Or I will just do 7650. It makes it easier. Okay. I'll make this 7650 so everything is closely related. Okay, so, and the historical volatility, I will set it at, say, 18%. So if you look at this, then as per the Merton model, the price of the option should be 98.19. Here you see this one, that's 98.19. However, we see that in the market, that this option is trading at 135. So obviously there is something not correct. And the thing that is not correct is that our estimate of the volatility, because what generally was seen was that the Black-Scholes Merton model wasn't really pricing the options correctly, because the theoretical price that the model was giving was a little bit different from the price of the options in the market. Now, the reason behind this discrepancy between what the model was giving and what the market was showing was essentially because of the assumptions that the mathematicians had when they devised this model to price the options. So later on what was figured out is that, okay, fine, the model might not be giving us the right idea, might not be giving us the right price. But if we notice one thing, that all the factors are quite observable except one factor. So we see that the price of the share is extremely observable. There's no discrepancy about that. The strike price is fixed. There's no discrepancy about that. Time to expiry is quite observable. Interest rates are extremely observable. Dividends are extremely observable. The only thing that is not observable is volatility. So let us do one thing. Let us not use the model to price the option. Rather than let us use the model to back out what the volatility is. And that is what the market calls implied volatility. So what you see here in this list of IV, this implied volatility is nothing but the Black-Scholes model. It's a back calculation to back out the implied volatility, given that these are the prices in the market. So if I go back here and if I give that 135 is actually the price, then it will give me an implied volatility something in the range of 23%, which is exactly what the implied volatility is in the market. So you see 22.3%, and here it's 23%, or some very similar. Now, with regards to theta, here I see that the theta is minus 4.13. Minus 4.13 essentially implies, and this is the model which is calculating the theta, the Black-Scholes model. And minus 4.13 essentially implies that if nothing else changes in the market, and this is important, nothing else changes in the market, then every day the option would lose 4 rupees. So if nothing else changes tomorrow and Monday, then the option would have already lost something around 8 or 12 rupees because we passed 3 days and nothing changed. Of course, the market is closed, but still that counts because we still investors sometimes still price the total time and not only the trading days. So we see that around 4 rupees will be gone from your from the price of the option if you simply held this option and did nothing and nothing changes in the market. If the market remains as it is, then every day the price of the option will decrease by 4 rupees. That is essentially how you calculate the theta. I mean, you cannot do it with a pen and a pencil. Obviously, you have to use the model. So that's why this Excel file has been provided to you so that you can calculate various option briefs yourself. I hope that answers the question. Okay, so I have a question from Kalyan. What is the relationship between call and put delta? And Nitin is also asking me one more thing, how to come up with the historical volatility values. Okay, so the historical volatility value is, the best way to do it is that you download the prices of the options, download the price of the underlying asset. So for example, if you're looking at Nifty options, you download the historical, say 1 year or 2 year prices, daily prices of the Nifty, and you calculate their daily returns and calculate the standard deviation of that daily returns. The standard deviation that you get is an estimate of the daily volatility. You multiply that with the square root of 250 because generally it is considered that there are 250 trading days in a year. You multiply with that with the square root of 250 and you get an estimate of the historical volatility. So let me do that again for you. Let me tell you the steps again. So step 1 is you download prices, daily prices. That is important. Calculate daily returns and calculate the standard deviation of the returns and multiply with the square root of 252. Sorry. That should give you an estimate of the historical volatility. Is that okay, Nitin? Now to Kalyan's questions. What is the relationship between a call and a put delta? That's a very good question. So let me go to the option chain. So I hope everybody is familiar with this particular page. This is a very important page in the NSE website. Please give me a moment. So this is a very important page in the NSE website because this gives you a list of all the strike prices. So this is the Nifty call option and the expiry date is given here, 24th September. And this is the list of all the strike prices of the options ranging from 5,300 to something in the range of 11,400. Obviously, these are extremely out of the money and in the money options, and they're not really traded a lot. Most of the trading happens near the options which are at the money, so around say 7650. This is where most of the trading is happening. Now the question is, what is the relationship between the call delta and put delta? So it's not important to know the relationship between the call delta and the put delta, but you need to understand the characteristics of the call delta and the put delta. So what is a call delta? Call delta is essentially trying to measure the rate at which the price is going to change given 1 rupee increase in the underlying asset. So the rupees. So in simple words, call delta is the rupee, the price increase increase or the price change in the option price given a 1 rupee increase in the underlying asset. This is the basic definition of a delta. Now, generally, what happens when the price of the underlying asset goes up? What happens to the price of the call? The price of the call goes up. But what happens to the price of the put when the underlying asset goes up? When the underlying asset goes up, the price of the put falls down. So, essentially, the price of the call option, that call delta, which is the relationship between the call option and the share price, it's positive, because an increase in the share price will lead to an increase in the call option price. However, the relationship between the put delta, however, the sign of the put delta is negative, because the relationship between the share price and the put option prices are inverse. So if the share prices go up, the prices of the put options come down. So that's why the put delta is negative. So the call delta is positive and the put delta is negative. Mind you, this is only in the case where you're buying the options. When you're selling the options, it's the reverse. So let's stick to the case of buying the options. So when you buy a call option, your delta is positive, and when you buy a put option, your delta is negative, implying that your exposure to the underlying asset is positive in case of call. If the underlying asset goes up, you make a profit. However, your exposure to the underlying asset is negative in case of a put. So if the share price goes up, you will make a loss because the put option prices will fall. Now, so that is essentially what the call delta and put delta is, Kalyan. But the important thing, another thing which I also want to mention here is that the delta is different for different strike prices. So, for example, generally, as a rule of thumb, keep this in mind, that the options which are at the money, what does at the money mean? At the money mean that the strike price is equal to or very, very close to the underlying asset. So we see that the underlying asset is 7655. So the at the money option is 7650, which is the closest strike price. So this we can consider to be the at the money option. Generally, as a rule of thumb, this is not mathematically correct, but as a rule of thumb, as an estimate when you're trading options, do keep in mind that the delta of the options which are at the money are close to 0.5. That is, the call option, if you're buying a call option, it is plus 0.5, and if you're buying a put option, it is minus 0.5. What does that mean? That means if the underlying asset goes up by 1 rupee, you make a profit of 50 paisa if you buy a call option, and you will make a loss of 50 paisa if you sell a call option. However, for a call option, the more out of the money you go, that is on the left hand side of the screen, these are call options, on the right hand side are the put options. On the left hand side, the more down you go, the more the strike price is increasing. The options, the area in the white, are the out of the money options. The more out of the money you go, the less the delta becomes, the less exposure you have, the less sensitivity you have to the underlying asset. So something like an 8,600 call option strike price with strike price 8,600 has a delta much below 0.2 or 0.1 something. So that means your exposure to the underlying asset is extremely little. But the farther up you go, the more in the money you go, something like a 7,100, talking about calls, so the more something like a 7,100, this has a delta very close to 0.7 or 0.8. That means your exposure to the underlying asset is a lot more. The thing is exactly reverse for the puts. Well, it's reverse because for puts, out of the money options, the ones on the top, which have a strike price lower than the current underlying price. So the 6,600, 6,500, 6,850. So these parts on the right hand side, the part on the white, these are out of the money put options. Here the delta is below minus 0.1 or minus 0.2, much lesser because the sensitivity to the underlying asset is much low. And conversely, as the more down you go, the more deeper you go into the strike prices, the call options, the sensitivity increases and the sensitivity comes to something close in the range of minus 0.7 or minus 0.8. So that is what the delta is for a call and a put. So Nitin is asking, when it comes to Nifty, is it safe to keep the options overnight, or is it better to only execute intraday when it comes to options? Well, it completely depends on what your outlook is and what your strategy essentially is, on what exactly are you trying to do. The mistake that beginners do is that they only look at one factor, which prices options, that is the share price. They think that only if share price goes up, the option prices move. But beginners also need to keep in mind that there are other factors which are affecting this share price and the option price. And most important of them is time to expiry and volatility. If you keep the three factors, these are the three important factors that you need to keep in mind when you're trading options: the delta, the theta, and the vega. So the exposure to time to expiry, the exposure to the underlying asset, and the exposure to the volatility. Now, if you have these three things in mind, there is no trouble in keeping options, over 2 days or 3 days. What's going to happen if you keep an option, if you buy an option, if you keep it for 2 or 3 days? Of course, you have time against you because your options will lose value. But if you're doing the trade so that you have an idea that the underlying asset could move a lot in some direction, and you think that the amount of money that you will lose on the time, you will make up on the underlying asset movement, then it's fine. You can keep the options overnight or for 2 days or 3 days. It's completely fine. What is important is that you know your exposures, you know what risks you are exposed to, and your view of the market handles those exposures that you have. That is essentially what you need to keep in mind when you're trading options. So I have another question from Parth, which is, what are interest rate derivatives? Well, interest rate derivatives are nothing but simply derivatives. So what is a derivative? Here we are trading on options on the underlying asset, which is a share or an index like Nifty or a company's share. Similarly, you can have derivatives on interest rates, where the interest rates will go up or interest rates will go down. So if you have derivatives trading on interest rates, those are essentially interest rate derivatives. As retail traders, you generally won't be trading too much of interest rate derivatives. There is a section at the N.Sc. which has some interest rate derivatives, but it's not really. Should be here. Yeah, here's it. N.Sc. bond futures. So these are interest rate derivatives, but these aren't really traded at an extremely these aren't really traded a lot by retail investors. So it's not something that you need to think about now. I would encourage you to keep your focus on stock derivatives for now, and then once the idea is very clear, then you can probably move and trying to understand interest rate derivatives. But interest rate derivatives is essentially nothing but simply derivatives on interest rates. So I have two questions: what is risk-free return and how to calculate it, and what is hedging? The first question, what is risk-free return, is being asked by Sanjeev, and what is hedging has been asked by Advait. Essentially, the risk-free return of any country is the return that you will get on an investment which is supposed to be risk-free. Now, for any country, generally, this is not the case across all countries in the world, but generally, the bonds of that the country's governments are termed to be closest to risk-free. That is, it is highly unlikely that the government of a particular country will default on its own bonds. Although it's not true, there have been many cases where the governments have defaulted on their own bonds. But however, generally, it's an extremely rare event that a country defaults on its debt. So we had Greece defaulting on its debt, just a few months ago. Then we had Russia defaulting on its debt in 1998. We have Argentina defaulting on its debt in somewhere in the late 90s. So countries have defaulted on their debt. But however, it is an extremely rare event, and countries do not generally default on their debt. So the return, the yield that you get by holding a country's government bond, the debt of the government, is essentially the best estimate of the risk-free rate. So for example, India's risk-free rate should be something, the 10-year, if you want to look at the 10-year risk-free rate, it should be the 10-year government of India bond yields. So India's risk-free rates is something in the range of 7.754%. So that's how you would, if you would calculate, say, the risk-free rate. It's essentially the return of the government bond. What is hedging? Is what I've asked me. Well, hedging is essentially you're taking a position. You're taking a position in the derivatives market, whereby you are limiting your risk rather than increasing it. So, for example, if you buy a particular share, you essentially want the price of the share to increase. That's essentially why you're buying a share. But you are concerned that the share price might fall below a certain level. So let's say, let me give you an example. Let's say, this here. Okay, so let's say we have stock derivatives. We take stock options, and we take, say, Reliance. Okay, so let's say today we bought the say let's say on Friday we bought the today on Friday we bought the shares of Reliance Industries, and we bought them at, say, so we see the underlying value here is around 835. So we bought them at 835, and we expect the shares of Reliance to increase in value. But let's say what happens is that you are a little concerned that the share price might fall. So to hedge yourself, what you could do is you could go to the market and buy a put option of 800 worth 23 rupees 20. So if you buy these put options, you essentially hedged yourself. Whatever happens, you will not lose below 800, because 800 is the price at which you have an option to sell them. So you're setting yourself a limit below which your prices will not go down. This is sort of a hedging, because you're keeping yourself hedged to the possibility that the Reliance shares could fall below 800. So what you did, you bought a share worth 835, and then you bought a put option with a strike price of 800 worth 23.20. So you in total you paid around 858 rupees, and you bought an option and you bought the underlying share. You are in a hedged position because you know whatever happens, your losses cannot exceed 58 rupees, because you are completely hedged on the downside of 800. However, if the Reliance Industries does really well, and if the prices increase, then you're going to be making a lot of profit. So of course your profits start accruing above when Reliance prices go above 858, because you already paid 23.20 for the put option, so you have to cover that to make a profit. But you are hedged on the downside. Your downside is completely protected. You cannot lose more than, the share price cannot fall below 800. You're completely protected. That is an example of hedging. So Sanjeev is asking me that government bodies, so it means the government bond yield is, yes, the sort of the government bond yield is the risk-free return. Of course, you have to keep in mind the maturities, so because you have the entire term structure of the risk-free rate. So you have a 10-year risk-free rate, you have a 6-month risk-free rate, you have a 1-year risk-free rate, so it's important to know which risk-free rate are you looking for. Are you looking for the 10-year risk-free rate, or the 6-month risk-free rate, or the 1-year risk-free rate, or the 2-year risk-free rate? But yes, the government bond yield of that particular maturity is the best estimate of the risk-free rate for that maturity. So Vishal is asking me hedging with one more example. So Vishal, okay, I'll explain this again. So suppose you bought a Reliance share at 835. Okay. If you bought the Reliance share 835, then you are essentially expecting that the price of the Reliance share would go up. Now, but you are a little concerned that the Reliance share could also fall. The price of the shares could fall, and you want to protect yourself on the downside. To protect yourself on the downside, what you could do is that you go and you buy a put option with a strike price of 800,
and you pay 23.20 for that. So what happens now? What happens is that if the Reliance share prices go up, fine, you will make money on the underlying asset because the underlying asset is increasing in value. The put option will decrease in value, yes, that is true, but your increase in the underlying asset will be more because for a 1 rupee increase in the underlying asset, you will make a 1 rupee profit. But the 1 rupee increase in the underlying asset will only cause the Reliance put option price to decrease by, let's say, 20 or 30 paisa. So for a 1 rupee increase, you're actually making a profit. For a 1 rupee decrease, of course, you're making a loss, but you are hedged till a certain point. That is, till the strike price hits 800. Below that, you're completely hedged because even if you hold this position of the share and the put option till expiry, you know you cannot lose more than 58 rupees. That is the maximum that you could lose if you hold this till expiry. That is essentially a hedged position that you have because you have protected yourself on the downside, but you're open on the upside. That is an example of hedging. So the number 58 we are coming at is 23 is what we pay for it, and 835 is what we are is the price of the option. It is the price of the share. So 23 plus 35, that's the 58. That's how we are coming to. Because what you essentially need to do is that for this, if you want to hold this, so suppose you do the trade on Friday, and if you hold this trade till 24th of September, then the share price of Reliance needs to be at least above 858 for you to make a profit. Why? Because till the expiry of the 24th of September, all the time value of this option will have gone. So there will be no time value of this option because this is an out of the money option. You see, because the underlying value is 835 and the strike price is 800. So all the money, the entire value of the option price is time value. This entire 2320 is time value. If you hold this option till the expiry and nothing changes in the market, then this entire 2320 will evaporate, will vanish. So if nothing changes in the market, if you hold this option till expiry, then you need the underlying value to be at least above 858 for you to start making a profit. That is where from the 58 number is coming. But you are protected on the downside because you know that even if the share price falls to say 600, even if the share price falls to 600, the maximum that you lose is 58. Why? Because you have the option of selling it at 800. So even if it falls to 600, you can sell it at 800. If you sell it at 800, the loss that you make on the share is 35, and the loss that you make on the option price is 23.20. So the maximum that you lose is 58.20. Well, actually 58.20. So that 58.25 to be exactly precise. So that's where from this 58 number is coming. Sanjeev is asking me in the Black-Scholes formula which risk-free rate should be used. As I mentioned in this example that I showed, that you should be using the current risk-free bond yield, the 10-year bond yield, or I should probably to be absolutely correct, you should be actually using the 90-day bond yield, the T-bills, the 90-day T-bills yield. That is what you should be using in the risk-free rate because these options generally have expiries of 2 months or 3 months, and you should match your option expiry to your bond maturity expiry. That's what you should be using. However, the Nifty website, the NSE website, what they do is that they essentially use a flat 10% rate to calculate their IBs. And that's why I use the 10% to be consistent with how the Nifty, how the NSE does it. So they're using a 10% rate. However, to be absolutely correct, you should be using a 3-month, a 90-day T-bill rate as your risk-free rate. So when I was giving this, so Vishal, when I was giving this example of 58, I was doing it only for one share and one option. Yes, you're right that there's a market lot that you have to actually do it at lots of 250. But this example that I was giving was of only one share and one option. You cannot do that in the market, I know, because you have to trade in lots. But my example was only on one share and one option. So Parth is asking me what is the role of gamma. Okay, gamma is a little bit of it's a bit of a complicated Greek. So what happens is that your delta. Okay, I cannot draw. So is there a picture here? Okay, I will try to explain by word itself. Okay, so the thing is that the gamma, the delta of the option is not fixed. The delta of the option changes with the change in the underlying asset. Okay, so for example, let me go back to the Nifty chain. If you see these option we see that this 76. We know that approximately that the 7650, which is the at the money option, has a delta of 0.5. But when if say the Nifty goes up by 200 points, then this 7650 call option becomes deep in the money or in the money, because then the at the money is the 7850 option. So when this 7650 option becomes in the money, then its delta is obviously not 0.5. The delta has increased to something like 0.6 or 0.65. Because of this delta increasing, we need to know of how much does the delta change by given a change in the underlying asset. That is essentially what the gamma is trying to measure. Of what is the exposure of the delta, mind you, what is the exposure of the delta to the underlying asset? Delta is what is the exposure of the price to the underlying asset. Gamma is what is the exposure of the delta to the underlying asset. That is what gamma is essentially trying to do. For beginners who are trading in the option markets, you do not immediately need to think about delta gamma a little too much, because gamma mostly comes into practice for dynamic hedging, where you're hedging at a constant, constantly in every 30 minutes or every day or something like that. That's where the gamma is important. For you as beginners in the option market, the three Greeks that you need to keep in mind are the vega, the theta, and the delta. The gamma and the rho are not so important for you right now. Okay, keep posting your questions. I'll just take a 2 minutes break and I'll be back. Keep posting your questions in the chat, and I will pick up those questions from there. Just give me 2 minutes, please. Right, thank you. So I have a lot of questions. So let me see where to start. Okay, so the first question is from Sanjeev. He's asking, how is the open interest important in deciding bullish or bearish, bullish or bearish or short covering trends? Okay. The open interest is sort of a measure of how many open contracts are there in the in a particular derivative. Now, what happens is that this is only when you're talking about open interest deciding bullish or bearish or short covering trends, you're generally talking about futures, because the same conclusions cannot be drawn from option open interest. It's mostly futures open interest that you can draw these conclusions from. So essentially what is happening is that when the open interest of a particular futures, like say the open interest of Reliance futures, so let me open this, let's say, let's go here. Yeah, so let's say we have this, the Reliance 24th September stock futures. And the thing is this, that when the open interest is increasing and when the price is increasing, it is a bullish trend. Why? Because when does an open interest increase? When open interest increases, when new and new contracts are being created in the market. Now, when more and more contracts are being created in the market and we see that the price is increasing, then this is a sort of a view that more people are coming into the market with a stronger view on the upside than on the downside. So when the open interest is increasing and the stock price is increasing, that is short of a bullish trend. On the contrary, when you have the open interest decreasing and when the open interest increasing, keep this in mind, the open interest increasing and the share price or the futures price decreasing, then we have a bearish trend. Why? Because open interest increasing means more and more people are coming into the market and taking new positions. But the price decreasing is an indication that there is a bias on the downside. So more people are there's a bearish sentiment, and that's why more people are coming with view on the downside than on the upside, with a more stronger view on the downside than on the upside. So open interest increasing, futures price decreasing is a bearish sentiment. Open interest decreasing and share price increasing is short covering. Why? Because people are now leaving from the market, and when people are leaving from the market and the share price is increasing, that is what people who initially had short positions are okay. But what does the future price increasing indicate? The futures price increasing indicates that there is a pressure on the upside. Now, open interest is decreasing. That is, people are leaving from the market. When people are leaving from the market and the share price is increasing, it's an indication that these were people who had short positions and they are now covering their short positions and leaving the market. Similarly, when we have an open interest decreasing and the share price decreasing as well, that is essentially profit booking. Why? Because open interest is decreasing, people are leaving from the market, and the futures price is also decreasing. That is because these people who had initially bought, they are now booking their profits, they are selling and they are leaving. That is how you would use open interest to look at bearish sentiments and bullish sentiments. But keep in mind, this is just a view. This is by no means a theorem where it has to be that way. There could be many other factors which are causing the open interest to increase and the price to be. So it could very well be that the open interest is increasing the price is also increasing, but the market it's probably a bearish market. So this is by no means like a Bible truth. It's just an opinion, or just a lens, a glass through which you view the market. So the open interest and the share price, the combination of these two is just a lens of looking at the market. It's by no means foolproof. Okay, so that is how the open interest works.